our mission is to upskilling or kickstarting your career before graduation. Pregrad was founded by Ankur Saxena and Madhav Chaturvedi in 2021. And Pregrad offer many upskilling programs powered by Wipro, IBM, Cisco, Meta, and many more. So this is all about the Pregrad. So what about the session? Let's begin the session. So are you excited for the session? Write in the chat box. All the requestees and attendees, your mics and your cameras are off, so please write in the chat box. And if it is required, please raise a thumbs up. I will be on your mics. So may I know today's guest speaker name? कौन बताएगा मुझे गेस्ट स्पीकर का नाम आज? Write in the chat box the speaker name. Yes. So a very warm welcome to Sir Chiranthan Bhattacharya, who is the founder of C. Bhattacharya and Company. He is an ex-assistant manager at Deloitte. So Sir Chiranthan will be our guest speaker of the master class. So requested to all attendees, please welcome him. Hi sir, how are you doing?
Hi Shrashti, thank you. Thanks for the invite. And a very good evening. Namaskar to all the officials of Pregrads and to all the students who have joined on this Sunday afternoon. I know it's a very bitter task to ask students to join on a Sunday afternoon holiday. I mean, we are very thankful that you guys have taken a time out of your busy schedule and came all the way to listen to what I have to speak. Okay. So, Shashti, shall we start or we shall be waiting for?
Yes, sir. We can start.
We can start?
Yes, sir. So all the
Okay.
attendees, your mics and cameras are off. Please requested to all of you, please write your queries in the chat box, and if required, please text me. I will be there. I'll on your mics.
Thank you, Shashti.
We can start the session.
Okay, great. So to all the students, if you have any queries, you can park it for the end of the session. Or if you think if it's very urgent, you can raise your hand, or you can also drop down your question in the chat box. Then maybe we can cater to your question and give the apt response. Okay. I hope I'm clear. Now, let me just share my screen to you all.
So I can share this, share the PPT if you want.
I guess it's visible. Is it visible, everyone?
Yes, it is visible.
Okay. So, just a minute. Just give me a moment. Okay, so before I commence, let me just give you a very brief introduction of mine. I'm Chiranthan Bhattacharya. I'm a chartered accountant by profession, and by passion, I'm an orator, I'm a speechifier, I'm an educator. I just go around giving sermons, talking to students, solving their problems, and that's what my passion brings me here. Now, I'm a partner at C. Bhattacharya and Company, a very old chartered accountants firm, and I manage the audit and taxation part of this firm. So that was more about me in very brief. And more importantly, what we should be knowing is the direct tax structure. So the objective of this session is not to make you all an expert in direct tax, because trust me, it's now almost close to 16, 17 years I've been a chartered accountant, and yet I cannot call myself an expert in this particular sphere or function or subject, I should say. So it has got numerous sections, numerous provisions, sub-provision, explanation, and it takes years and years of labor and pain to become an expert. So our objective for today's session is to give you a brief understanding of the direct tax structure, so that by the end of this session, you become aware of what exactly direct tax structure is, and also to help you making enable you to have working knowledge at least. That's our objective. So, shall we proceed? Okay, great. So, let us first start our deliberation with the word tax. What do you mean by the word tax? Tax is a very common word which everyone actually comes across in every day of life. But it's a basically very old word. It's the word has been derived from the Latin word taxare, which means assessment or to compute. So when somebody says that I'll tax your income, it means I'll assess your income, I'll compute your income. Now the question usually arises, a layman usually asks us, why should we pay tax? The question should be, why should not you pay tax? I'll give you the understanding of it. Suppose you go one day to play cricket with your own bat. Okay, so your friends enjoy the cricket by playing with the bat that you have brought to the field. Okay, so what do you take exchange in bargain? You ask for what? You ask for first batting, first bowling, wicket keeping, right? You try to get the best out of the entire game for yourself. Why? Because they are enjoying the game of cricket with the help of your bat. It's the same thing. If you are using the resources of a country, simple as that. If you are using the resources of a country to earn your livelihood, to earn receipt, to earn income, you have to give something to that land. That something in return that you are giving is nothing but a cut that we commonly call as tax. So it is very important that a person who is actually using the resources of a particular country pays tax to that country. It's the moral obligation of a particular person. So next time if somebody asks you, why should you pay tax? You should counteract with saying, why should not you pay tax? It's a moral duty, it's an obligation of every citizen. Okay, now there are two types of taxes in India, the direct tax and the indirect tax. We'll focus on direct tax, but you have to understand the difference between direct tax and indirect tax. Now, the word direct is itself very self-explanatory. It means what happens is that, suppose I'll give an example. There's a person A. The tax is levied on A, and if it is paid by A, then it is called direct tax. That means the person on whom tax is being levied and the person who is paying the tax are the same person. And it is always applicable on income. So it is, if you read the third bullet point, the burden of the payment is on the person earning the income. So there is this person A, tax is levied on him and it is also paid by him only. So that means the burden of taxation cannot be shifted. In direct tax, the burden of taxation cannot be shifted. But in indirect tax, the burden of tax can easily be shifted. I'll give you an example. If you go to a hotel to eat out something, okay. Now, while paying the bill, you see the restaurant owner is charging 5% GST. Okay, 5% GST is being charged. GST is a form of an indirect tax. Now, the tax is levied on who? Is the tax levied on the restaurant owner or is the tax being levied on you? The answer is the tax is being levied on the restaurant owner and it is not levied on you. So that means who has the obligation to pay the tax, not to pay the tax, to levy the tax, the restaurant owner, but he's collecting the tax from you. So that means the burden of tax is ultimately falling not on the owner, that means not on the person on whom tax is being levied, but on the ultimate consumer, that is you. So the burden of tax, the liability of the payment of tax is being shifted to whom? To the end consumer. That is the difference between direct tax and indirect tax. In direct tax, the burden of taxation cannot be shifted. The person on whom it is being levied, he has to pay. In indirect tax, the person on whom it is being levied, he doesn't pay. He collects it from whom? From the consumer and pays it to the government. That means the burden of payment in indirect tax is shifted. Usually you will see people cry more over direct tax than on indirect tax, because indirect tax is a tax which you don't feel that you are paying. Shall we move to the third slide? Okay. Now let's understand about direct tax. The first question that should come to your mind is, who basically controls and governs it? The answer is CBDT. What is CBDT? CBDT, the full form is Central Board of Direct Taxes. Now, what exactly it is? It is a statutory body under which department? Department of Revenue, Ministry of Finance. Now, what's the objective of CBDT? We can say it is an administrator of direct tax. It ensures policies, it ensures planning, it ensures collections, it ensures governing of the entire direct taxation. So, which is the body which controls the entire direct tax or governs the entire direct tax? We can say it is Central Board of Direct Taxes. Now, Central Board of Direct Tax governs it, but it should be governing on basis of certain rules and regulation, right? And those rules and regulations are stated in Income Tax Act, which is nothing but the law governing the direct tax. So Income Tax Act is what? The law which is governing the direct tax. The body which is governing the direct tax is CBDT. So CBDT is being CBDT goes under the laws of Income Tax Act 1961. The history of Indian taxation goes back to the year, I guess, in 1850, when it was formally introduced in India. And the first act, Income Tax Act 1922, came into existence, which continued till 1961, when the Income Tax Act 1961 was formulated, and in April 1962 it was enacted. Since 1962 April till date, we are governed by the same law. Now, when I say same law, it doesn't mean the same law that was enacted in 1961. There has been lot of amendments, lot of changes that have been made every year, within year, every time whenever there is requirement, suitable changes and amendments are made in the income tax law, which basically specifies the rules and regulation for governing the direct tax. So, which is the body which governs the direct tax? CBDT. Which is the law which governs the direct tax? Income Tax Act 1961. Now, as we said, direct tax is a tax on income. So that means first the receipt has to be classified in the classified as income, only then it can be taxed. It can be assessed. So what are the 5 heads of income? That means the receipt needs to be classified under 5 heads of income. What are those 5 heads? Income from salary, house property, capital gains, PGBP, other sources. So these are the 5 heads. What are those? We'll slowly go through one by one. Till now, do we have any questions, or shall we proceed? I guess we are good to proceed. Okay. Income from salary. Now, for a receipt to be classified as salary, the first and foremost thing that should be understood is the relationship between the payer and payee. The person receiving the income, as receiving the amount from the person, that means the person who is giving it, the payer, and the person who receives it, payee, should have an employer-employee relationship or a servant-master relationship. If it is not an employer-employee relationship, if it is not a servant-master relationship, it will not be classified as salary. So for a receipt to be classified as salary, you have to check the relationship between the payer and the payee. As simple as that. If it is employer-employee, servant-master, it will be salary or else not. For example, if there is a contractual person who has been given a contract to do a work, but he is not under the direct supervision of the payer, then it will not be an employer-employee relationship, and payment to such contractual person will not be considered as salary. Now let us talk about what the salary include. Now I'll give an example. Suppose your salary becomes payable on 31st of March and you get your salary on 15th. Will the March salary be considered as your salary for the entire financial year, April to March? The answer is yes. Why? Because if you read the second bullet point first Third word includes due. Due means even if it is not paid. So that means your salary becomes due on 31st, but it is being paid on 15th. So even if it is not paid, if it is due, it would be considered as your salary, taxable salary. The second point is advance salary. That means if you receive any salary in advance, that means it is not due, but you have received it, then also it would be considered under the head salary. And lastly, the arrear of salary. Arrear of salary means, suppose uh, there is a retrospective amendment in DA. DA means dearness allowance, which forms a part of salary. So there is a retrospective amendment of dearness allowance for last 10 years. So for last 10 years, the DA is increased and you get it in the current year. So that is nothing but arrear of DA. So that arrear which you get in the current year will also be considered as the part of your salary. So your salary will include the amount which is due, not paid. Advance salary means salary which is not due but paid, and arrear of salary, salary which has been accumulated due to retrospective changes. Lastly, salary would also include perquisites. Now, what are perquisites? Perquisites are non-monetary benefit. Usually, many of the times, employer gives the employee a lot of non-monetary benefits. For example, he might give you a car, he might give you a driver, he might give you a free education for your children, he might give you free hospital care, he might give you free accommodation. So these are what? These are non-monetary perquisites. That means he is not charging anything from you and he is not paying you in terms of monetary terms. He is just providing you the facilities. So suppose you are being provided the facility, then the monetary value of such facility, please understand, the monetary value of such facility will also be considered as salary. Now, why monetary value? Because of the money measurement concept that you read in accounts. I hope you know the part money measurement concept in accounts, which says that anything which has to be valued has to be converted in terms of money. So any non-monetary advantage that you receive from the employer has to be converted into monetary terms and will be included in the salary. So what constitutes salary? Very simple. Advance salary, due, arrear of salary, and also perquisites. Now we have few questions. What do you think? A pension received by retired employees, will it be a part of salary? The answer is yes. Why? Because uncommuted pension, not the commuted pension. Please remember, uncommuted pension will always be part of salary because it is being received from the employer. There was an employer-employee relationship. The person retired. Now he is receiving pension from whom? From the employer only. So the relationship coexists. It continues. So the pension will also always be considered as salary income. Next, we need to understand what is standard deduction. I'll come to the salary to partner form 16 later, but let's understand what is standard deduction. Standard deduction means that you arrive at the gross salary after adding every advance salary, arrear, due, perquisites. From that, under section 16, you have allowed to take a flat deduction or subtraction of 50,000. Flat subtraction of 50,000 to arrive at the net salary on which tax is computed. So you arrive at the gross salary. From there, you subtract the standard deduction. Standard deduction means an amount of rupees 50,000 flat is subtracted from the gross salary to arrive at the net salary on which tax is computed. What do you think? Salary to a partner, will it be income from salary? What check do we need to do? The first bullet point, employer-employee relationship. Does the partner and the firm pays the partner's salary? So that means, do you need to check the relationship between the firm and the partner? Do you see employer-employee relationship? The answer is no. There is no employer-employee relationship between the firm and the partner. And as a result of that, the salary received by the partner from the firm will not go under income from salary, even though the term used is salary. It will not be classified as income from salary. Now let's talk about Form 16. What is Form 16? See, these are very practical questions I'm discussing with you. What is Form 16? Now, what has happened is that the government has given the liability of deduction of tax on the employer. So the government has said that if you are paying an employee rupees 100, and if his tax on rupees 100 is 20, you have to pay him only 80 and deposit 20 in my credit. The government has specified very clearly. Government with the CBDT has clearly specified very clearly that you will have to pay the employee only 80 and deposit that 20 into my my credit. So that 20 is nothing but tax deducted at source. What is Form 16? Form 16 is a statement which will give you detail about the tax that has been deducted from your salary. So it's very simple. It's a statement which will provide that in this financial year, this is the amount that has been deducted from your salary. Now, Form 16 has two parts, Part A, Part B. Please remember, these are very practical things, Part A and Part B. Part A talks about the amount of tax that has been deducted, and Part B gives the detail about the salary, detailed breakup of the salary. How much salary has been paid, what is the standard deduction, how much tax has been deducted, every detail is provided in Part B. So that was all about salary in very brief and in a very practical way that I wanted to explain it to you. Moving on to the next head, house property, income from house property. Now please understand, the term used is house property. Understood? House property. And so I'll give an example. Example would be much easier to understand. Suppose you are a person who has a flat and you have given it out on rent. The flat generates rent, right? So that means you are receiving something which is in form of income, which needs to be taxed. Can it be a salary? No. So where will it be? Where will it be classified? It will be classified under income from house property because the rent is being generated due to the house property. That means there has to be a house in question, in context. Sorry, there has to be a house in context. So that means, suppose you are owner of a vacant land, and that vacant land is also generating rent. What do you think? Will that rent be classified as house property? No. Do you know the reason why? Because there is no house as such in existence on that vacant land. It's a vacant land. Therefore, the income generated from the vacant land will not be considered as house property. Now, there are certain conditions which are to be fulfilled for an income to be classified under house property. And the first one is that the person should be the legal owner of the house property. Suppose you are not the owner of the house property and the property generates some income, can such income be classified as can be classified under income from house property? The answer is no. You have to be the owner. So then what happens if a tenant sublets a house? That means I'm a tenant. I live in a flat. I sublet the flat to a third party. I collect rent from him. So does that rent be classified as income from house property? The answer is no. Why? Because I am a tenant. I'm not the owner of the house property. So my income cannot be classified under income from house property. Now the question comes of tax evasion. Usually what happens is that people transfer their house in the name of to their wife or to their minor child just to evade this tax levy. So what the law states very clearly, that if you are transferring a house or a flat to your wife without sufficient consideration, to your wife or your child without sufficient consideration, then you will still be considered as deemed owner. Even though the real owner will be the wife, but for tax collection, you will be assumed as the owner of that property. That is why it is called deemed owner, assumed owner. to prevent tax evasion, this particular, scheme was enacted. Now the point is, suppose the husband and wives are, taking a divorce, and in the contract of staying apart, the husband transfers a house to the wife. For example, the alimony that he is giving to the wife is the flat that he is transferring to the wife. In such case, will he still be considered as the deemed owner? Now the answer is no, because now the transfer is genuine. The transfer is with sufficient consideration. It is a genuine transfer. It is not a sham transfer. It is not a transfer to evade tax. So that is why in such cases the owner will be the wife and the husband will not become the deemed owner. Now that takes me to the third question. What happens if I run a business from the house property? What happens then? Now, suppose if you're running a business from the house property, and if it generates income, it will not be classified under income from house property, because it's a business. And for business, we have a separate provision. Point number 3, read subpoint. Is it possible? Yes. In such case, what happens? First, the answer is no. As per Income Tax Act, only 2 houses can be self-occupied. The other 2, in such case, will be assumed to be let out. Even though if they are actually not let out, it will be assumed to be let out. That means you can say that I can live in 2 of my houses, but from the 3rd house onwards, it would be considered as deemed let out, even though if it is actually not, for computation of income from house property. So how many properties can be self-occupied by a person? The answer is 2. More than 2, not possible. Now let us come to the point, how can we compute income from house property? Now please remember, income from house property is computed by calculating the gross annual value of the property. Now what is gross annual value? I'll just touch upon that in a very brief fashion, because it's a very big term. So gross annual value, from gross annual value, you subtract municipal tax that you have paid, you arrive at the net annual value. From net annual value, you again subtract 30% of NAV. 30% of net annual value you can subtract for repair and maintenance of the property. Then you can subtract interest on borrowed capital. The amount that you arrive at is the income from house property on which tax will be charged. Now let us talk about gross annual value. Gross annual value is nothing, it's very simple. It's the potential rent that a property will generate in a particular locality, valued on. So it will be considered as the potential rent that the property can generate. That is nothing but the gross annual value, or the municipal value, whichever is available to you. Now, the most important point is point number 5, interest on borrowed capital. Suppose you have taken loan to purchase the property. You are paying EMI on that property. EMI consists of what? Principal and interest both. Income Tax Act specifies that the amount of interest that you are paying, you can subtract it from the gross annual value to arrive at the income from house property. That means it basically reduces the burden of taxation to a great extent. Now the question is, how much interest is allowed to be subtracted? Please remember it very carefully. To the extent of 2 lakh only, maximum 2 lakh only for self-occupied, and for let out there is no restriction. For self-occupied, to the extent of only rupees 2 lakh per property, and for let out there is no restriction. So for example, if you are generating, if you have taken a loan, and if the interest on such loan is 1,50,000, you can take the entire deduction of 1,50,000 from the gross annual value to arrive at the income from house property. So suppose you have a property which is generating rent 100. So 100 will be the GAV less municipal tax that you have paid. From that, 30% should be subtracted, and the interest on borrowed capital. Once you have done all these subtraction, you will arrive at income from house property. That's the second head that we have discussed till now. Let's move on to the third head, which is the biggest head, and I should say is the most complex and complicated head: profits and gains from business and profession. Now, what we need to understand over here, the terminology used. It says business and profession, and it includes vocation as well. Vocation, you know, I hope, is the skill set that a person derives due to his inherent qualities, like a singer, a painter. So that's vocation. So any receipt that you are getting out of performance of business, performance of profession, performance of vocation will be taxable or classified under this head. Now, please remember the term used is profits and gains. It does not say receipt from business and profession. It says profits and gains. That means you are allowed to deduct all the expenditure that you have incurred to earn that receipt. That means any expenditure in the business, you are allowed to subtract it from the receipt to arrive at the profit or gain. And on that profit and gain, you will be charged tax. So that means you are allowed to take deduction of expenses like rent, rates, taxes, insurance, repairs, depreciation, preliminary expenses, insurance premium, bonus, commission, contribution to PF, ESI, bad debts, advertisement, any other expenditure. Now, this is 37 subclause 1, which clearly specifies in Income Tax Act that you can take deduction of any expenditure provided it has been used for the purpose of business and it is a revenue expenditure. You can take deduction of any expenditure which has been incurred for the purpose of business and it should be a revenue expenditure. So that means there is no restriction as to what are the deduction that you can take. And that is why this is the most debatable, debatable head. Most of the notices that are issued from the department to the SSCs are on this under this head only, because the most, I should say, it's the most debatable, most complicated, most complex section. So that now that takes us to the question that what if we receive a purchase it from a client? For example, I'm a chartered accountant, my client liked my service. Now instead of making payment in money, he gives me a BMW. What happens then? Will it be considered as a receipt? The answer is yes. So the monetary value of the perquisite, that means the monetary value of the BMW, will be considered as my receipt. And the expenditures incurred to earn that receipt will be allowed as deduction to arrive at profit and gain. Is the simple profit and loss that you prepare in accountancy. A little bit of difference. So next question is, what do you think about interest, salary, bonus, remuneration received by a partner? Now please remember, by any name whatsoever, if a partner receives any amount from the firm, be it interest, salary, bonus, remuneration, it will always be classified as profits and gains from business and profession. And though the term used is salary, it will not be classified as income from salary. That takes us to the final question: is cash expense allowed? Now that's a very tricky question. Is cash expense allowed? The answer is yes. Cash expenses are allowed, but to certain limit. Now what is that limit? Section 40A subsection 3 of Income Tax Act clearly specifies that you can make payment in cash to the extent of 10,000 per person per day only. Please remember this. This is very important. 10,000 per person per day only, and not beyond that. This has been done to check tax evasion and also to check accumulation of black money. And with this, we come to the fourth head, which is the capital gains. Okay, to understand capital gains, first we need to understand what is capital asset. What is capital asset? Capital asset means property. Property means anything which is owned by you. Do not assume property means a house or a flat. Property means anything which is owned by you. So capital asset has been defined as anything which is owned by you. It doesn't matter if it is fixed or circulating, movable or immovable, tangible or intangible. It doesn't matter. What matters is it should be a thing which should be owned by you. Now, fixed means suppose a machinery. It is fixed, circulating, stock in trade, movable, your car, immovable, your flat, tangible. Tangible means which you can touch, feel. So all the car, machinery, everything is tangible. Intangible means which you can't touch, which you can't feel, which you can't see. For example, right to a property, right towards asset. These are what? A right is an intangible asset. So is it a capital asset? The answer is yes. So anything which is owned by you, it doesn't matter if it's fixed, circulating, movable, immovable, tangible or intangible, it is considered as capital asset. Now, when does capital gain arises? When you transfer capital asset, suppose you have a flat which you have purchased for rupees 100. One fine day you decide that you want to sell it off. You want to transfer in form of selling. So you sell it off at 200. So you purchased it at how much? 100. You are selling it off at how much? 200. So are you making a gain? Yes. And the gain is of how much? 100. So do you need to pay tax on that gain? The answer is yes. On under which head? Under the fourth head, capital gains. Okay. Now let's see the question. The questions are very interesting in this. A right to an asset, will it be a capital asset? I have already discussed. A right to an asset will be a capital asset, even though it is intangible. Next question, stock in trade, will it be a capital asset? Stock in trade means suppose you are a person who is dealing in saris and you have a lot of stock of saris with you. Will those saris be considered as capital asset? The answer is no, because they are business assets. They would be sold at a profit and the difference will be charged under which head? Profits and gains from business and profession. So business stock in trade is not a capital asset. Please remember that. Business stock in trade will not be considered as a capital asset. What about the car that you drive? Is it a capital asset? It's a thing which is owned by you, so it should be capital asset, but it has, what do you call it? It's a personal effect. Any asset which has a personal effect will not be considered as capital asset. Personal effect means intimacy with the asset. For example, your clothing. Your clothing is also a thing which you own, but it's a personal effect. It has a very good intimate relationship with the owner. So it is not considered as capital asset. So your vehicle, your motorcycle, your shirt, your trouser, these, even though they are capital asset, will not be considered as capital asset. Why? Because they are personal effect. So that means considering this, jewelry should also not be a capital asset, right? Now that is very true. Jewelry is personal asset, but just imagine if jewelry is kept out of the purview of being capital asset, any transfer of jewelry will go tax free. Now the tax department was very worried. What they did, they put an exception to personal asset. They said that that motor vehicle, that any belonging which has personal effect or which has intimacy with the person will be considered as personal effect and will be kept out of purview of capital asset, except jewelry. So jewelry has been made as an exception to personal asset, even though they are very intimate to the owner. So now you know what is capital asset. Now you understand a very brief of how capital gain arises. Now, capital gains are taxed under two methods. which is called long-term capital LTCG, long-term capital gain tax, short-term capital gain tax. Long-term capital gain tax at a flat rate of 20%. Short-term capital gain tax is charged as per the slab. Now, how does a gain become short-term or long-term is basically on the basis of how many months have you held the asset. Suppose you purchase the asset on a particular date, you are selling it off on a particular date. The period for which you have held it determines whether it's a short-term capital gain or a long-term capital gain. So, how do you define short-term capital asset? A short-term capital asset means any asset which is held for a period not exceeding 36 months. So if you are holding an asset for a period less than 36 months, it will be short-term capital asset. And if you are transferring such asset, it will become short-term capital gain. If you are holding assets for exceeding 36 months, it will be a long-term capital asset. Now, if you are transferring such asset, it will be a long-term capital gains. So please remember 36 months is the cutoff. But again, direct tax never makes your life easy. It always ensures that there is certain kind of ambiguity always. So what they did, they stated certain exceptions. Question number 1, listed equity share held for 13 months. Will it be a long-term or short-term capital asset? Now, as per the definition, it should be short-term, but it's an exception. A listed equity share, if they are held for more than 12 months, it will be long-term. Then what about unlisted equity shares held for 13 months? It should be long-term. Now again, there is an exception that if it is an unlisted equity share, then the period of holding should be 24 months. That means the period for which you should hold it to make it long-term, it should be 24 months and not 12 months. So please remember, if it's a listed equity share, for example, if you buy a share of Reliance India RIL, and if you sell it, and if you sell it after 12 months, it will be a long term. If you sell it within 12 months, it will be a short term. Unlisted means which are not listed on any stock exchanges. So next slides brings me to the computation of capital gains. How do you compute it? Very simple. The consideration for which you sold it, the expenditure, I'll just quantify it. Suppose you have a flat, you sold it for 100, so full value of consideration will be 100. Now you gave 10 rupees to the selling agent. So your expenditure for transfer will be 10. So 100 minus 10 is 90. You purchase the flat for 50. So 100 minus 10 minus 50 comes to how much? 40. 40 will be your capital gain. Now, what is cost of improvement? Suppose you had only ground floor. You prepared a first floor as well. It's a cost of improvement. That means you purchased the flat for 50. You made certain improvement or enhancement in the flat for 30. That means the total cost will become how much? 80. So 50 acquisition, 30 improvement. Then we have also exemption under section 54, which we will not discuss with you because it's a very long section and it will take a lot of time. So please understand, it's a simple value of consideration, less expenditure for transfer, less cost of acquisition, cost of improvement will give you the capital gains. The last one. Income from other sources. It's a residuary clause. Now, what do you mean by residuary clause? That means if there is a receipt by a person and which cannot be classified in the above 4 heads, that means neither it can be classified as salary, nor can it be classified as house property, nor can it be classified as PGBP or capital gain, it will be charged to tax under income from other sources. Example, dividend. Suppose you are receiving dividend from a company. Is it a salary? No. Is it a PGBP? No. It's a house property? No. It's a capital gain? No. Then it will be under other sources. You go to You go to all those like Kaun Banega Crorepati. You participate in Kaun Banega Crorepati. You earn 1 crore rupees from there. Again, can it be classified in the above four heads? No. Then it cannot go tax free. So it has to be taxed. So it is taxed under income from other sources. For income from vacant land, suppose rent from vacant land, where will you charge it? Can it be can it be house property? No. Can it be PGBP? No. Can it be capital gain? No. Then under this clause, residuary clause, income from other sources. Suppose you get a gift from a stranger exceeding 50,000, monetary value 50,000. Will you have to pay tax on it? Yes. If you receive a gift from a stranger exceeding 50,000, you have to pay tax on it. Exceptions are except on the day of your marriage. Suppose you are getting married, you are getting gifts from unknown people exceeding 50,000. Tax will not be levied. But you have to prove that you got married. So just for the sake of saving tax, don't get married multiple times. Okay, that's not a way to save tax. Okay. Then we have forfeited advance money. See, the list is like goes on and on and on. That's why we have kind of concluded it with etc or etc. It includes everything. So thus we complete all the 5 heads, a basic understanding of all the 5 heads: salary, house property, business profession, capital gains, and lastly the residuary clause, other sources. अगर ये चारों में नहीं जाएगा तो आपका income from other sources में taxable होगा. This is the moral of the story. Okay. Now let's proceed further. How do we compute tax? This is the format that is in front of you. Please go through it. Nowadays, you have come across another term called alternative tax regime. The regular tax regime, the alternative tax regime. The alternative tax regime has basically come into effect in the previous assessment year. Alternative tax regime or new tax regime. Now, what is the difference between regular tax regime and alternative tax regime? You need to understand. So please focus. So we have gross salary over here. From that, standard deduction is subtracted. That comes to net salary. Then income from house property, PGBP, short-term capital gains, income from other sources comes. If we add all these items, we arrive at gross total income. Now, please see. Under regular tax regime, we were allowed deduction under these sections. What were these sections? Tax saving investments. You must have heard it from your father's mouth. Tax saving investments. So in regular tax regime, we were allowed these deductions. But in new tax regime, these deductions are not allowed. Now you must be wondering, kya fayda? It's a bad bargain going for new tax regime, alternative tax regime. But the answer is no. Why? You'll see in the next slide. So deduction is given, you arrive at the net income. In new tax regime, no deduction. So your gross total income becomes the net income. And on this net income, the tax is calculated, on which health and education cess of 4% is charged. That comes to your gross tax liability. From which the TDS means the tax that has already been collected from you. So that means you have already paid tax for it. So it will be subtracted, which will make you to arrive at the net tax liability if you still have certain tax to pay, or if you have paid more than what is being calculated, you'll get a refund, or you get your tax back from the department in form of refund. So the difference between regular tax regime and the new tax regime is you don't get the benefit of all these deductions. Now, what is the advantage of new tax regime then? Check this. This one is the slab for old tax regime. This one is the slab for new tax regime. Do you see the difference? In the old tax regime, no tax has to be paid till 2,50,000. In the new tax regime, no tax has to be paid till 3 lakh. That means you get an advantage of 50,000 over there. Then from 2,50,000 to 5 lakh, you pay tax at 5%. Here, from 3 to 6 lakh you pay tax on 5%. That means again on 1 lakh you are paying tax at a lower rate under new tax regime. Under old tax regime, 5 lakh to 10 lakh you have to pay tax at a high rate of 20%. But here if you see in the new tax regime, 6 to 9 lakh you pay tax at the rate of 10. And from 9 to 12 lakh you are still paying tax at the rate of 15%. Not you haven't reached 20% yet. So that means till 12 lakh you are paying at a rate much lower than the old tax regime. Now above 10 lakh it says that you have to pay tax at the rate of 30%. That means if your net income, that means if this amount goes above 10 lakh, you'll have to pay tax at the rate of 30%. Now, if you see over here, 30% here is only above 15 lakh. That means for 5 lakh, you are paying tax at a lower rate of 20%. So in totality, you will see after calculation that you are saving tax by opting new tax regime than going for the older tax regime. But if you are taking full benefit of deduction, then in certain circumstances, older tax regime turns out to be beneficial. So you have to do the math before coming to the conclusion whether older tax regime is advantageous or newer tax regime. But to be generally speaking, till 15 lakh total income, it is seen that new tax regime is advantageous, and over 15 lakh, it becomes, both of them becomes irrelevant. Both of them are very close. The tax liability becomes very close for both of them. Lastly, we have to see what ITRs that need to be filled. I've stated over here, simple.
Sorry
Yes.
for interruption. We have one question from Chandra.
Okay.
Yes, Chandra, you can speak. Your mic are on.
Good evening, sir. This is Suraj. Actually, my question is that, sir, in new tax regime, then there we can file ITR and not we cannot file the ITR.
No, you have to file ITR. Who said new tax regime you cannot file ITRs? You have to file ITRs.
Deductions are not applicable in there, no, sir? 80C, 80D, and 40.
Deductions are not applicable, but you are not exempt from filing income tax return. Income tax return is mandatory for everyone who is getting total income above 2 lakh 15 old regime and above 3 lakh in new regime.
Then we cannot refund. We will not get refund in this regime.
No, you will get refund. See, you will get refund if your TDS is more than the computed tax. That means if your tax has been deducted more than the actual tax liability, you will get a refund.
Okay, sir. Thank you.
Any other questions? Anyone?
Yes.
Okay. So we are almost very close to the end of the presentation. So these are the various ITRs that you need to fill. So suppose if you only have salary income and that to below 50 lakh and only one house property and very insignificant other sources income, you have to fill ITR 1. ITR 1 is very simple. Anyone can file it. Even you can do it on your own. It is so easy. Now, if you have total income above 50 lakh, then you will have to file ITR 2. Or suppose if you have more than one house property, you have to fill ITR 2. But ITR 2 cannot be filled by person having business profession. If you have business profession, then only ITR that is made for you is ITR 3. If you have business profession, you should file ITR 3. If you have salary and business profession and house property, still ITR 3. Then comes ITR 4. ITR 4 is for presumptive taxation. Presumptive taxation. Okay, we'll skip presumptive taxation because it will become very difficult for you. Then comes the ITR 5. For example, if you are LLP means limited liability partnership, or if you are a partnership firm, if you are an association of person, if you are body of individual, such identity, if you have, then you have to file ITR 5. For companies, it is ITR 6. And for trusts and societies, it is ITR 7. So for individual An HUF, ITR 1. For individual HUF with more than one house property or total income exceeding 50 lakh, ITR 2. For individual HUF having business, ITR 3. For any other identity other than individual HUF, ITR 5. For companies, ITR 6. And for trust and societies, ITR 7. The last are the dates which you should remember. July 31st is for everyone other than those whose books of accounts have to be audited. Audited means have to be certified by chartered accountants. If your books of accounts have to be audited by chartered accountants, then your due date becomes October 31st. Belated return means you forgot to file return on July 31st, then you have time to file return till December 31st. जुलाई 31st निकल जाने पे ऐसा नहीं है कि आप रिटर्न नहीं फाइल कर सकते हैं, आप फाइल कर सकते हैं टिल व्हाट डेट, दिसंबर 31st. रिवाइज रिटर्न, अगर आप कोई ओरिजिनल रिटर्न में गलती करते हैं, इफ यू मेक सर्टेन एरर्स, सब्सटेंशियल एरर्स और in filing return, you can file a revised return. Again, what is the due date? December 31st. Then last is the updated return. Suppose you forgot to mention few income. Later on you realize, अरे I forgot, ये वाला income तो मैंने डाला ही नहीं. In that case, you can go ahead and file updated return. Now, what is the difference between revised return and updated return? Updated return will always increase your income. Updated return can never reduce your income. Remember that. So if you have to file updated return, it should always, the result should be increment of income and not reduction of income. So please remember, July 31st is the date. If your books of accounts are not audited, books of accounts audited October 31st. If you forget July 31st, December 31st is the time for belated as well as revised. And if you have forgotten to mention certain income, source of income, please file an updated return and stay safe. You don't have to worry about tax authorities coming knocking at your doors. Thank you. Now, this house is open for questions.
All the attendees, please requested, if you have any doubts, please raise a thumbs up and ask question.
I have tried to keep it very simple. I mean, as simple as possible. And I hope you guys have made some understanding out of the presentation.
Yes, Shweta.
Good afternoon, sir. My question was that as a student, I think we all should be aware of this basic information. So what else should we, do research or study related to this particular topic? I mean, we all need to be very aware of these topics, no? So other
Yes.
than these direct taxes, what are all other things that we all should know, and where can we get all of this information?
Okay, so Shweta, there are a lot of books available in the market, but the point is, the books are very elaborate and descriptive. Okay, so you might find it very difficult to comprehend because they are very in-depth. They go very deep into the knowledge. Okay, so what you can do is you can get this slideshow from Srashti. Okay, and in relation to the slide, whatever has been mentioned, you can do a research on internet and get a basic understanding of taxation, because trust me, the presentation that I've given you is sufficient enough for basic understanding and filing of returns. You don't need to do anything more. But if you're still interested in going ahead with it, please buy books from Dr. Vinod Kumar Singhania, Dr. Girish Ahuja. They are very prominent writers in the field of taxation. So you can refer their books, but they are very descriptive. I'm telling you, very descriptive. They write books meant for us. So I hope you can understand. Can we become partner to a company rather than an employee in order to skip taxes? You can't skip tax. You can't skip tax. See, Uh, if you are an employee, your receipt will be classified under income from salary. Fair enough? If you receive it from a firm, your receipt will be classified under income from business profession. So only the classification changes. You get my point? The taxation structure, I mean, the implication of tax stays there. It's not going anywhere. The classification changes. So from so instead of being charged under income from salary, you will be charged to tax under income from business and profession. So you cannot, I mean, you can run, but you cannot hide from taxation. That's the thing. And please don't even try to hide. They will catch you. Any other question?
We have a question. What innovative tech strategies are emerging in the era of digital currencies like Bitcoin and Ethereum?
Can you send me the question, because I didn't get you.
What innovative tech strategies are emerging in the era of digital currencies like Bitcoin and Ethereum?
Okay. Now I'll tell you what, digital currency is in a very nascent stage. So there is no tax strategy as such that has been developed, because if you see in this budget only, the provision of Bitcoins and all those were taken into consideration. So we are still in a very nascent phase, and we have still have to work a lot to basically to ensure that Bitcoins and all these what should I say, Bitcoins and all this digital currency taxation are taken into consideration, and tax strategies can be developed on it.
Any further questions, students? No more questions. Okay, we have one other question from Harun Joshi. How can individuals who work freelance or have side hustles navigate the complexities of self-employment, tax and deductions?
I need to read the. Okay. What innovative tax strategies are emerging in the era of digital currencies? We have done that. How can individuals who work freelance or have side hustles navigate the complexities of self-employment, taxes and deduction? So what exactly is your question? What exactly do you want to know from me? Please be more specific, because it's a very vague question.
Harun, you can turn on your mic also.
Suraj, please hold on to your stocks for another 6 to 7 months. And then it will become a long-term capital gain, and then you will be paying less tax on it. I should, never go short on stocks, especially in the current situation. India is really is in a very promising position. So hold on to your stocks; it will do well in future. How might freelancers and side hustlers strategically utilize tax deduction unique to their self-employed, such as home office, expense, business related? Yes. See, what did I tell you? I told you that to earn that receipt, if you have expended any amount, that will be considered as a probable deduction, as an acceptable deduction. So suppose, I'll tell you what. Suppose you are eating. Suppose you meet with your client in CCD or in Barista, and if you pay the amount over there, that bill you can actually charge as an expenditure for computing taxation, for arriving at the income to compute tax. So, you can take deduction of any to every expenditure, provided it is related to the business. As simple as that. And it should be in the nature of revenue. These are the two conditions that are being laid. See, commutation of pension is, for example, I'll make it very easy for you. Suppose I retire, I will never retire, but suppose I retire and I start getting from the company 100 rupees per month as a pension. Now the company tells me, Chiranthan, why don't you commute your pension and instead of getting 100 per month, you take straight away 4,000. So I'll take 4,000 straight away from the company and company will stop paying me pension. That is called commutation of pension. So when you take a lump sum amount from the company, instead of taking a monthly amount from them, it is called commutation of pension. Now commutation of pension is exempt to some extent, is tax-free to some extent, because commutation is always propagated. Even the tax people propagate, even the company, even the government want people to commute their pension. Okay. I hope I made some sense over there. How to save tax on mutual fund? How to save tax on mutual fund? First of all, go for ELSS, equity linked savings scheme. Once you basically invest money in such mutual funds, you turn around saving tax under Section 80C. Okay. And also, please ensure you hold your mutual fund for a longer period of time. The holding horizon should be at least 5 years. Now, when you hold it for a longer period of time, the return is good, even the taxability is less. Never go short on mutual funds. That is a piece of advice I'll give to every one of you. Wait, what is the meaning of cost of acquisition and capital gains? Cost of acquisition and capital gains. So suppose you buy a flat for ₹100, you spend 50 rupees on registration of it. The cost of acquisition of the flat will be 150. As simple as that. Cost of acquisition means the amount you expend to acquire the asset. Acquire means acquire till the time you bring it home. For example, you purchased, I hope you have read it in accountancy as well. Suppose you purchase a refrigerator and it took around 100 rupees to bring it back. Bring it to the office or to the industry. Then you have to add it. The price of conveyance, the cartage has to be added to it, to the cost of acquisition. Sir, if I go to other countries, so does Indian government take tax? No, if you become non-resident, tax will not be applicable, provided there is double taxation avoidance agreement with those countries. Whenever you go to outer countries, there are DTA, double taxation avoidance agreement with every countries. But the name clearly specifies double taxation. So that means if your income is taxed over there, it will not be taxed over here. If it is taxed over here, it will not be taxed over there. But it is not as easy as it seems. It's difficult because they have some elaborate arrangement and elaborate agreement with every other country. So if you go there and if you become non-resident, till the time you are resident, it might be, but if you become non-resident, your salary will not be taxable.
Any further questions, students? No more questions. So thank you so much, sir. We believe your expertise and insights would be valuable to our participants.
Thank you, Shrashti, and thank you, Pregrad, for giving me this opportunity. It would not have been happening had you not got in touch with me. Thank you. Thanks a lot.
Thank you so much, sir. Thank you once again for your time and consideration. Like, it is a wonderful session and content. All the attendees, please join the WhatsApp group for this PPT and sir LinkedIn profile. You can add him into your LinkedIn profile, and all the details of certifications would be provided in the WhatsApp group.
Okay.
So
Thank you.
Please write in the LinkedIn post. Thank you, sir. Thank you so much for joining.
Thank you.
And thank you, audience, for joining.
Okay.
We have one message for you, sir, that it was one of the best explanation I ever heard. Understood so complicated, so simply. Thank you very much, sir. You are awesome.
Thank you. Thanks for such nice words. It's all because of you guys. You were there. That's why I was so excited and so motivated. Thank you. Thanks to all of you.
Uh, uh, Pandemic AK Gaming. Sir, can I take 2 more minutes, please? You can turn on your mic and you can ask questions, whatever you want to ask. Waiting. Okay. And just a moment. How can I start?
You're from IIT Kharagpur, so buddy, you have brains. Don't worry. Okay. So you can start from anywhere. You just need brains to start. You have it. Trust me, it's not difficult. Complete your IIT Kharagpur complete your course over there. And what I suggest is that try for MBAs from IIMs and go for finance specialization. Or if you're interested, you can also go for ISB. ISB is one of the prominent business schools, and I guess one of the best ones. So there are a lot of venues and opportunities to learn finance. So don't worry.
Sir, what one advice you want to give to our college going students?
Advice as in, please remember, read. Reading is a habit that you have to develop. Trust me on this. Read anything to everything. That I would suggest to every one of you. And don't read rubbish. Rubbish means don't read WhatsApp forward messages. They are not knowledge. I mean, those are rubbish. Don't watch YouTube videos of rubbish people. If you really want to seek knowledge, read books. Read books. They are the main source of knowledge. Because what has happened with the current generation is that they are so much into mobile phones and so much into all those idiots on YouTube that they have completely forgotten to read. So please read books. Books are the real source of knowledge and nothing else. Trust me on this. Read as much as possible and nothing else. That's it.
Thank you, sir. Thank you so much, sir. Thank you, sir. Thank you so much for joining.
Thank
Thank you,
you.
audience, for joining.
Thank you. Thank you.